Time now for our exclusive segment, Worth It, where we bring you investment ideas from some of America's best money managers that are featured in Worth magazine. Joining us today is Craig Pastolove. He is Senior Vice President with Morgan Stanley Smith Barney, Excelsior Wealth Management. Craig, welcome to the show. Craig, we're going to start with the fact that you guys are in a lot of cash. 15, 20%, the markets are rocking, it's exploding. You've got a lot of high net worth clients. Are they upset that you're in this much cash, or are they participating somehow?
Well, first off, thank you for having me. I'm very happy to be here. By way of background, we have a multifamily office practice. And that family office practice, we cater to the unique needs of high net worth individuals, and we work with their families. So the number one mandate that we have when we're working with wealthy clients and their families is to preserve their capital. So for us to have a cash position and preserve their capital, we've been actually rewarded many times, and we're able to take advantage of opportunities that may present themselves.
Right. Okay. Last year, the S&P Dow was up just slightly because I think everyone, was seeking comfort of safety. Utilities were up. NASDAQ was down. The exact opposite. Did you see an opportunity toward the end of last year to say, okay, you know what, this is overdone. Let's put some of this cash to work in areas that didn't work, but maybe are just a little oversold? Or is the risk, was that reward, potential reward, not worth that risk?
Well, actually, when we've seen some of those sell-offs occur, it's usually because emotions take over and people are responding to headlines. And anytime people are responding to headlines and they begin to sell, they're willing to get rid of risk assets regardless of what price they can get for those assets. So it wasn't more than a year ago when municipal bond markets sold off precipitously as they were calling for mass defaults in that asset class. Because we had a significant cash position at that time, we were able to allocate money to the municipal bond market, add to our core positions. We were able to pick up significant yield that wasn't available before. And in 2011, that turned out to be the best performing asset class for us by far.
But sometimes, Craig, when investors sell, it doesn't mean it's a good buy. It's not a good buy. It doesn't make sense to pick it up a lot of times because it is fundamentally not necessarily a growing asset class or growing, stock or equity or bond or what have you. So how do you kind of decipher between fire selling and actually sort of panic selling that isn't really based on fundamentals or actually valuations as well?
Right. Well, we have at Morgan Stanley, we have a team that focuses nothing on research, and especially in the asset classes that we're very comfortable in. And for our high net worth clients, something like fixed income, when we see sell-offs in an asset class that we've historically been incredibly comfortable with, we would look at that any time, which already happened in 2008, right? In 2008, the same thing happened. People sold off conservative assets and were willing to take anything that they can get for it. And you have to be willing at that time to step in and to pick up so you can profit while other people's panic.
You're also getting into some pretty sophisticated vehicles. You're talking about covered calls, investing in MLPs. Is this something that reasonably an average investor should even be dipping into? Is this something that more savvy investors should be doing with the help of a trained investment professional like yourself?
Well, oftentimes we see the mistakes that people make is in the choice of the investment vehicle that they use. Sometimes it makes sense to use a passively managed index or an ETF. Other times when we feel that security selection is very important, it makes sense to use a actively managed or an institutional money manager. And there are other times, like when you have periods of market duress, that some of the other strategies that are less liquid become quite attractive, and these are available to anyone, such as closed-end funds, right? Closed-end funds, which trade at a discount often to their net asset value, when normal asset classes are selling off, these can be hit pretty hard. So it's at those times you can pick up $1 worth of assets many times for 75 or 80 cents.
Right.
So we've seen this over and over where great quality, relatively safe assets have been sold off the last few years. You guys have taken advantage of it. But again, your strategy is more preservation of capital, whereas someone watching the show may have to take a few more risks than your clients do. Craig Pastolove of Morgan Stanley Smith Barney, thank you very much. We appreciate it.
Well, thank you for having me. I'm happy to be here.
Well, we've got some breaking news now.